Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Reinsurance Group of America Incorporated Annual Report. Reinsurance Group of America Incorporated offers a diverse range of businesses and services that cater to various needs of its clients. The company provides reinsurance solutions for mortality, morbidity, lapse, and investment-related risks associated with products. This includes individual and group life and health insurance products such as term life, universal life, whole life, critical illness, disability, and longevity products. In addition to these products, the company also offers asset-intensive and financial reinsurance products, as well as other capital-motivated solutions. Furthermore, Reinsurance Group of America develops and markets technology solutions that cater to the needs of the insurance and reinsurance industries. The company also provides consulting and outsourcing services for its clients. The company operates globally, with a presence in the United States, Latin America, Canada, Europe, the Middle East, Africa, and the Asia-Pacific. With over 4 decades of experience, Reinsurance Group of America has established itself as a leading provider of reinsurance and financial solutions worldwide. The stock price of Reinsurance Group of America Inc., RGA, has increased by over 14% in the past year, driven by several key news events. One significant factor was the company's strong fourth quarter 2025 results, which saw net income available to shareholders reach $463 million and adjusted operating income increase to $515 million. This outperformed analysts' consensus estimates and led to a 7.4% jump in stock price on February 6, 2026. RGA has also demonstrated its commitment to returning value to shareholders through active capital management and strategic transactions. The company deployed $2.5 billion into enforced transactions for the full year 2025 and repurchased $125 million in shares during 2025. Additionally, RGA announced a new share repurchase program of up to $500 million and declared a quarterly dividend of $0.93 per share. The company's strategic partnerships and investments have also contributed to its positive performance. The successful completion of the $32 billion reinsurance transaction with Equitable Holdings, Inc. bolstered excess capital and is expected to contribute significantly to pre-tax income in 2026. Furthermore, RGA made a strategic investment and served as a multi-fund anchor backer to Foxpath Capital Partners, a credit secondaries specialist. Analysts have also maintained a positive outlook for RGA, with a moderate buy consensus rating and an average 12-month price objective of $243. The company's inclusion in Fortune's World's Most Admired Companies list reflects its focus on client value, corporate responsibility, management quality, and talent retention. Overall, the combination of strong financial performance, strategic transactions, active capital management, and positive analyst ratings has contributed to RGA's stock price increase over the past year. Reinsurance Group of America Incorporated maintains a market capitalization of $15 billion, broadly in line with the industry peer group. Reinsurance Group of America Incorporated trades at a higher price-to-earnings ratio of 13 times and a higher price-to-book ratio of 1.09 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 91% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in various industries can be attributed to several key factors. Net investment income has emerged as a significant driver of revenue growth, particularly in 2025. Financial instruments such as interest rate swaps, total return swaps, and credit default swaps have also contributed to revenue growth during this period. Equity options have been another source of revenue growth, with notable gains reported in 2025. Investment-related gains and losses from investments like mortgage loans, limited partnerships, and real estate joint ventures have also played a crucial role in shaping revenue trends. Tax planning strategies, including the utilization of deferred tax assets and foreign tax credits, have further contributed to revenue growth. However, geographic-based segments have shown varying levels of revenue growth or decline, with some regions experiencing growth while others declined. For instance, the U.S. and Latin America segment saw an increase in revenue due to adjusted claims and other policy benefits, whereas the Europe, Middle East, Africa, Asia, Pacific, and Canada segment experienced a decrease due to future policy benefits remeasurement losses. Overall, these factors highlight the complexity of revenue growth or decline in various industries, emphasizing the need for a nuanced understanding of the underlying drivers. Net income and profit margins experienced significant fluctuations between 2023 and 2025. Initially, net income decreased by 20% from $902 million in 2023 to $717 million in 2024 due to various factors such as adjusted claims and other policy benefits, future policy benefits revaluation losses, and interest expense. However, the trend reversed in 2025 with a substantial increase of 86% from $717 million in 2024 to $1,182 million. Profit margins also underwent changes during this period. While some segments showed improvement, such as RGA America's Reinsurance Company, Limited, which saw its profit margin rise to 19.3% in 2025 from 12.5% in 2024, others experienced declines. The U.S. and Latin America segment, Europe segment, Asia segment, and Canada segment all witnessed decreases in their profit margins. The reasons for the decrease in net income and profit margins were largely attributed to adjusted claims and other policy benefits, future policy benefits revaluation losses, and interest expense. These factors had a significant impact on the company's financial performance during this period. The company's financial performance is a key indicator of its overall health and stability. A review of the operating cash flow reveals a positive trend for the company. In 2025, the net cash provided by operating activities was $4,091 million, indicating that the company generated sufficient cash from its core operations to meet its financial obligations. Comparison with previous years shows that the company has consistently generated positive operating cash flow. In 2024, the net cash provided by operating activities was $9,370 million, a significant increase from 2023's figure of $4,044 million. This upward trend suggests that the company is effectively managing its finances and generating sufficient cash to support its growth. Overall, the data indicates that the company is generating positive operating cash flow, which is a crucial aspect of its financial performance. The company's debt level has undergone significant changes over the past year. Long-term debt has seen a substantial increase, with notable rises in specific notes, such as the $700 million 7.125% fixed-rate reset subordinated debentures due 2052. This increase is reflected in the total debt level, which rose from $761 to $1,038. Interest expenses have also increased significantly, with notable increases reported in various sections of the company's financials. The shift towards fixed-rate debt and interest rate swaps has led to changes in interest expenses, resulting in higher costs for the company. Additionally, the increase in undrawn bank letters of credit by 215% from $126 million to $398 million has also contributed to the rise in interest expenses. Overall, these changes suggest that the company's financial situation is becoming more complex and potentially riskier due to its increased debt levels and higher interest expenses. The performance of various segments and regions within the company has been mixed, with some areas excelling while others struggled. Segments that performed well include Asia-Pacific Traditional, which saw a significant increase in premiums from 2023 to 2025, with growth rates of 16.7% and 10.4% respectively. The U.S. and Latin America Financial Solutions segment also experienced a substantial increase in premiums in 2024 compared to 2023, with a growth rate of 98.6%. In Canada, the traditional reinsurance segment performed well, with a $23 million increase in adjusted operating income before income taxes. In addition, the individual life business in Canada and the financial solutions segment in Canada also performed well due to favorable experience. The EMEA, Europe, Middle East, Africa segment saw an increase in total segment revenues of 22%, although its adjusted operating income before income taxes decreased by 12%. Asia-Pacific operations also performed well, with a significant increase in total segment revenues and adjusted operating income before income taxes. On the other hand, some segments struggled. The international operations were affected by various risks, including political, financial, and social instability. Variable annuity products with guaranteed living benefits were also impacted by changes in equity markets, interest rates, and volatility. In Europe, Middle East, and Africa, financial solutions, premiums decreased from 2023 to 2025, with a decline of 36.1% and 34.2% respectively. In Canada, the traditional segment saw a decrease in premiums from 2023 to 2024, with a decline of 6.7%. The U.S. and Latin America traditional segment performed poorly due to less favorable management actions compared to the prior year. Additionally, the group business in Canada struggled due to unfavorable claims experience in individual life and group health business. The company's outlook and strategy are centered around achieving strong financial performance, stability, and growth. The management has reported a 44% increase in net cash provided by operating activities, indicating a positive trend. To further enhance its financial position, the company is expanding its services to include various financial solutions such as longevity reinsurance, asset-intensive products, and pension risk transfer. The company's investment strategy focuses on allocating 100% of investments for long-term growth, with target allocations determined to maximize returns while minimizing volatility through adequate asset diversification. This approach demonstrates a commitment to prudent financial management and a focus on sustainability. In terms of risk management, the company is focused on managing longevity risk through the sale of insurance products and transferring mortality risk through reinsurance. This proactive approach helps mitigate potential risks and ensures the company's stability in the long term. Overall, the company's strategy emphasizes the importance of regulatory compliance, with a focus on adapting to changing regulations such as the OECD's Pillar II legislation and the Inflation Reduction Act of 2022. With a strong leadership team in place, including Laura Cockrell as Chief Strategy Officer and Tony Cheng as President and CEO, the company is well-positioned for continued growth and success. The company has made several strategic moves through acquisitions and divestitures in recent years. In terms of acquisitions, the company has entered into a reinsurance transaction with subsidiaries of Equitable Holdings, Inc., which closed on July 31, 2025. This is not an isolated incident, as another transaction was also entered into with the same entities on the same date. In addition to these transactions, the company has made investments in private equity, hedge funds, and real estate joint ventures. These moves are likely aimed at diversifying the company's portfolio and increasing its revenue streams. On the other hand, the company has also engaged in divestitures, which involve getting rid of certain assets or business lines. One such example is the recapture of rights on reinsurance agreements with insurance company customers. This move allows the company to regain control over policies that were previously ceded to other entities. Another potential divestiture involves the disposal of assets on unfavorable terms in order to cover policyholder withdrawals or recaptures of reinsurance treaties. This move is likely a last resort, as it involves selling off assets at a loss in order to mitigate financial risks. The company has a history of rewarding its shareholders through dividend payments and share buybacks. According to the provided summaries, the company has paid dividends to its shareholders every year, with a notable mention of $240 million in dividends paid in 2025. In addition to dividend payments, the company has also engaged in share repurchases, with a significant amount of $673,114 million worth of shares repurchased in 2025. The data on share buybacks is consistent across different pages, indicating that the company has made a substantial investment in buying back its own shares. While there are slight variations in the numbers, it is clear that the company has prioritized returning value to its shareholders through both dividend payments and share buybacks. That concludes the financial summary for Reinsurance Group of America, Incorporated. Feel free to comment below, and I will be happy to answer them when possible.